What triggers market movements so drastic they can be labeled as one in a trillion events?
That's right. Experts George Gammon, Ted Oakley, and David Lin have invaluable insights to share.
In this video, we summarize their critical analyses into concise insights you can easily digest.
Stay tuned as we dive into the warning signs of a potential market downturn and what this means for investors.
Today, we explore a staggering event in the foreign exchange market as explained by George Gammon, who refers to it as a one in a trillion situation.
George highlights this phenomenon as an alarming indication of the fragility within our monetary systems.
According to George Gammon, the recent market event reflects how fragile our monetary structures have become.
He points out that many dismiss indicators like the inverted yield curve, failing to heed the warning signs it presents.
George believes that ignoring these signals could lead to dire consequences, especially in light of recent market tumult. George asserts that whenever there are significant market moves, central planners are quick to blame external factors like speculators.
He argues this narrative distracts from their responsibility for economic policies that contribute to instability.
Now let's consider how George addresses the failure of institutions to adequately hedge their risks.
He draws parallels with the Silicon Valley Bank collapse, illustrating how unhedged risks can lead to insolvency.
What predictions does George have about potential market impact from this event?
George anticipates that the repercussions could include increased volatility and bank bailouts.
What does George foresee based on the recent market turbulence?
He warns that without careful intervention, we could experience prolonged instability in the financial markets.
In conclusion, George emphasizes that for stability, both policymakers and financial institutions must acknowledge their accountability.
He advises investors to prioritize sound risk management tactics to prepare for ongoing fluctuations.
Welcome back to Kitco News. Today, we're analyzing market expectations based on insights from billionaire trader Paul Tudor Jones and wealth advisor Ted Oakley.
Ted Oakley shares concerns about the market's trajectory, echoing Jones's assessment that conditions are set for potential declines.
Jones asserts that the stock market is likely to reach new lows, even if potential rollbacks of tariffs occur.
Oakley expresses concern that the current sentiment among retail investors may lead to significant financial setbacks.
Jones calls tariffs high, indicating they are detrimental to economic growth.
He predicts that the trade deficit has skyrocketed to a record $140 billion.
Despite bearish market indicators, Oakley reveals retail investors are still heavily invested.
He warns that this complacency could lead to substantial financial losses.
Jones argues that shipping and oil price trends signal deeper economic issues.
Oakley believes these indicators reflect a weakness in the economy that is being overlooked.
Both Jones and Oakley predict a significant market correction.
Oakley suggests adopting a cautious approach by holding cash.
Oakley advises that investors should maintain cash reserves to prevent panic-driven decisions.
He recommends looking for value opportunities in the market rather than following prevailing trends.
Today, we're exploring insights from David Lin regarding the upcoming FOMC meeting and its implications for the markets.
David emphasizes the importance of Jerome Powell's remarks on inflation and labor data, predicting a significant market reaction.
So, what are David Lin's views on the potential market reactions post-FOMC?
David suggests that uncertainty around inflation rates and employment data will heighten volatility in both equities and bonds.
How does David interpret Powell's communications strategy?
David notes that a hawkish tone could lead to market downturns, while dovish remarks might spur a rally.
What predictions does David make regarding market movements?
David anticipates that the markets could see significant shifts, particularly if statements contradict current investor expectations.
What might be the expected corrections post-FOMC meeting?
According to David, we could see corrections of 5 to 10% based on Powell's outlook on economic stability.
So, how should traders prepare for the uncertainty?
David recommends keeping a close eye on inflation rates and responding quickly to market trends based on Powell's statements.
Today, we're diving into a critical analysis of California's housing market by David Lin.
David highlights a dramatic surge in inventory along with a significant drop in home sales across the state.
David Lin explains that a supply-demand imbalance is pushing home values lower.
He points to March's 0.44% price drop as a significant indicator of this change.
What does David Lin say about inventory levels in major Californian cities?
He notes significant increases, such as a 67% rise in San Diego and 52% in Los Angeles.
How is affordability affecting home sales in California, according to David?
David highlights that the median household income necessitates spending approximately 61% of earnings on home ownership, which is unsustainable.
What historical trends does David bring up regarding price declines?
He reminds us that California experienced a 41% drop during the last recession, emphasizing the historical volatility.
What does David Lin predict for the future of home prices in California?
He forecasts a decline of approximately 0.8% over the next year, largely due to increased inventory levels.
In conclusion, what strategies does David suggest for potential home buyers?
David recommends that buyers stay informed about inventory trends and be prepared for price fluctuations as the market adjusts.
Welcome back to Real Estate Mindset. Today, we're discussing the economic challenges highlighted by Mitch Vexler, focusing on Ford's layoffs and Rite's bankruptcy.
Mitch explains that Ford's layoffs are a response to deeper economic issues, including inflation and changing consumer behaviors.
Mitch notes that Ford Motor Company has opted to lay off a large number of employees, primarily due to significant economic vulnerabilities.
He adds that Rite's second bankruptcy highlights its ongoing struggles to maintain competitiveness in a challenging market. Mitch explains that Ford's layoffs are mainly tied to ongoing economic concerns, including a weak consumer market.
He stresses that these layoffs reflect broader issues of debt and inflation affecting consumer spending. Mitch states that Rite's recent bankruptcy, its second in 18 months, underscores its struggle to stay relevant in a competitive landscape.
He discusses the difficulties Rite faces adapting to consumer trends and rising competition in the retail pharmacy market.
Mitch predicts that Ford will need to make significant changes to its operations to rebound from current challenges.
He cautions that without a turnaround strategy, Rite may face further declines or consolidation in the retail pharmacy sector.
Mitch concludes that the interplay of debt and operational mismanagement poses significant challenges for investors and landlords.
He highlights the need for understanding economic factors affecting not just these companies, but the broader housing market.
Today, we're exploring significant stress indicators in the credit markets, as detailed by the host of Eurodollar University.
The host notes that extreme values in markets, particularly credit default swaps on U.S. government debt, signal potential problems in the banking sector.
The host outlines how the recent spike in credit default swap premiums reflects anxiety in the banking system.
They indicate that the increasing premiums are linked to banking sector vulnerabilities, not merely to government debt default risk. The host mentions that key financial indicators such as Swiss franc remain near decade-high levels, indicating significant market anxiety.
Is this linked to concerns over the banking sector's stability?
Absolutely, these indicators reflect a pervasive caution, particularly regarding banking exposure.
The host highlights reports of investors in private credit offloading stakes at significant discounts due to worsening conditions.
This trend underscores a broader sentiment of concern as investors seek to mitigate potential losses.
The host cautions that rising credit default swap premiums signal potential trouble in coming months.
What does this mean for investors?
Investors must navigate increasing volatility and prepare for possible downturns.
The host predicts that investor caution will persist as they navigate through uncertainty.
The continuation of high credit default swap premiums is a strong indicator of ongoing market concerns.
The host emphasizes the importance of staying vigilant in this fragile economic environment.
They recommend closely monitoring credit indicators and market trends as we move forward.
What a whirlwind of insights today. Our experts really challenged us to think critically about our financial landscape.
Absolutely. Each guest brought a unique perspective, from Eurodollar University's alarms about the banking sector to Mitch Vexler's insights on layoffs.
And let's not forget David Lin highlighting California's housing market, such an important point about affordability.
Exactly. He also articulated the volatility linked to FOMC meetings. It's all interconnected.
For sure, and Ted Oakley's caution about the stock market risks really mixed things up. It's like a tug of war between optimism and caution.
Right. And George Gammon's insights on currency fluctuations add another layer of complexity. There's so much to unpack.
It's fascinating how these experts agreed on the fragility, but diverged on the causes and solutions.
And that's what makes these discussions so enriching. If our viewers found this conversation insightful, wouldn't you encourage them to like, subscribe, and share?
Absolutely. Their support keeps our channel alive and thriving, bringing more of this valuable content.
Don't miss our upcoming videos where we'll continue exploring these vital themes in finance.
Thanks for joining us. Until next time, keep questioning and stay financially savvy.